fourth quarter was a tough environment for equity investors. Starting in the end of September, growth was one of the first areas that was hit, and it was a pretty precipitous decline until we started to see earnings reports in late October, November, and things started to stabilize, particularly within growth. And then in January, I think it was a combination of investors being significantly positioned defensively, where tech had been momentum for the quarters preceding into that decline. The safety area really became the momentum area. There was a flood of capital into areas like telecom, REITs, and consumer staples. So that really became the new momentum. And I think people were kind of caught off sides, and as they looked at 2019 and thought that things actually were pretty good, particularly within growth, and global trade was a big question mark, capital started to flow back into those growth areas. So in the first quarter, there was not a lot that was hampered, generally speaking, for the market as well. I think the weakest performing sectors in the market were both healthcare and financials, and those were up north of 8% in the quarter. So while those were the underperforming categories, they still did pretty well, absolutely, although relatively they underperformed, versus areas like IT, which was up almost 20%. We did really well with our companies and our investments in Q1. There was one standout that really underperformed. That's a company called Casa Systems. They are mostly in the cable core systems business. So they sell to major cable MSOs, and we're in a downturn in terms of the CapEx cycle right now for them, which we were okay living through, but they also decided to make a very big acquisition and put some debt on the balance sheet, and that I was not satisfied with the strategic nature of those deals. So we significantly reduced that position in Q1. Growth stocks have had a great run. They've outperformed year to date by north of 400 basis points. And we're seeing less opportunities in those disrupting companies, broadly speaking. We think the fundamentals are still very much intact. The opportunity set is there, but the valuations just aren't what they were when we were putting capital to work last year. And so that's part of the reason that we've let some cash build up. We have found more opportunities in the evolving opportunity set and the compounders. So we've been adding new names there and increasing some of our position sizes in that space. We've also been working on some companies that we expect to go public. We participated in a small set in Q1, but we're expecting Q2 and Q3 to be rather active, particularly with some of the mega cap internet stocks that have been waiting in the wings, like an Uber, or a Pinterest, or an Airbnb. Also some more mid-ish cap companies that are in other industries that we've been getting to know those management teams more closely. We've also been doing our due diligence on some new private opportunities. Valuations are pretty expensive there, so we're being very careful and thoroughly de-risking those. So no promises that we're going to be participating in any of those, but we're really digging in on those.